Jeff Leighton is chairman of RedHill Biopharma, joins us live now from the Tel Aviv Stock Exchange. So let's start with healthcare stocks, just speaking there a little bit about the discrepancy between Europe and Israel. But let's just start by exploring the fact that why they have been doing so well, generally speaking.
Well, yes, it's a pleasure to be with you today. The stocks are doing well for a number of reasons, but one is that R&D costs have been minimized by outsourcing, basically. So the large pharmaceutical sector has done well by maintaining a large treasury and then being able to reach out to smaller sectors and acquire products and bring them in at end stage for development. So the cost to develop has been less than usual. That, however, has changed the sort of product mix. So we're very, very practical now in the pharmaceutical world, as opposed to looking out 10 years for product development. The idea is to bring things that are very practical to the market that are better for the patient, better quality of life, but shorter to the market.
But why haven't biotech stocks shared in these gains?
Well, biotech stocks, in general, biotech implies very, very early stage. Early stage risk of failure is very, very high in the biotech sector. Usually a biotech company will have one product that they're shepherding forward. If that product should fail in a clinical trial in phase 2 or phase 3, the biotech stock drops, it plummets essentially to inactive state. So the need in the biotech sector is to actually come forward with an idea that can you develop a business model in biotech that's highly commercial, that takes a way to reach out and acquire either at academic sites or from other companies products where most of the money has been spent, so to develop it, and where the risk of development has been minimized. And that's one of the strategies that's going on here in Israel with RedHill Biopharma.
Yeah, because I know that you're the chairman of RedHill, which is listed on the Israeli Stock Exchange, but shares in the company haven't done too well this year. How confident are you about the prospect?
Well, I'm quite confident in the products per se. The difference between biotech and RedHill Biopharma is RedHill Biopharma is really a development-based company that has acquired, invented, and has a proprietary position on products that have a very low risk of failure. So de-risk, addressing an unmet medical need, repositioned, novel formulations, easy to do clinical work, sometimes just bioequivalent studies to move forward. So, you know, RedHill is in the stage of development right now, so money's being spent to take these products forward. The good news is the balance sheet is strong, therefore there's enough capital available to carry these 6 products that they're developing all the way to registration stage. So I think as a whole, RedHill stock is down a little bit, but not relative to the biotech index as a whole.
And I suppose you mentioning the strong balance sheets, that is absolutely key for biotech companies because, as you say, it is very much a process of trial and error. There's a great deal of risk involved because you could end up investing in one or more products that eventually don't come into fruition the way you had envisaged.
Absolutely. You have to have enough patient capital, but the other thing is to select products that you know have a very low risk of failure. Most of the work has already been done outside of the organization. Bring them in, and you're really finishing the product. And so the key to a successful company that's development-based like RedHill here is the selection of the products that you acquire or invent. They have to be selected so that failure is low probability of failure. That's the key.
Thanks very much indeed for speaking to us this morning. Jeff Leighton, chairman of RedHill Pharma.